Yes.
Okay, so the objective, thank you. So the objectives today: describe the purpose of credit cards, determine which credit card is best for you, or if a credit card is a good option for you. Identify the factors credit card companies look for when making credit decisions. Describe how to use a credit card responsibly, and identify the steps to take when a credit card is lost or stolen. And I have this little cartoon here, and I'll read through it real quick. That would be $35 for the books and magazines. Wow, that adds up fast. I have the class trip next week. Cash or should I charge it? And she thinks about it. Here you go, I'll have to charge it. So if anyone wants to answer or type in the chat, do you think this was a good decision? Or do you think she should have paid cash for the magazines? I can forward the chat. Okay. So really, she probably should have paid cash for it. That would be my answer. And why is because $35 is not all. If you don't pay the bill in 1 month, finance charges will be added to the $35. So usually if it's $35, you'll get a minimum payment. We'll go through all this in a little bit later in a later slide, but it will add interest charges if you pay, say, $12 for the bill that month instead of paying the whole $35. Then that you're paying over $35 for it. So usually when it's a small amount like that, it's just better to use cash. Credit cards are really, and that's why we're going to go over why credit is important. It's really for like emergency type situations, or, you know, if you plan to pay the bill in full every month, just so you don't keep too much debt. So why is credit important? Credit can be useful in times of emergencies, is more convenient and safer than carrying large amounts of cash, allows you to make large purchases like a car or a house and pay for it over time, and can affect your ability to obtain a job, buy or rent a house, or obtain insurance. And a lot of adults find this out later in life, especially renting apartments. So now they actually check your credit to rent an apartment. So you always want to be responsible with your credit so that you'll be able to do things when you become an adult. And what is a credit card? Credit cards are a convenient form of borrowing. Keyword there is borrowing. It provides a revolving line of credit, require you to pay the minimum payment each month. And then you have charge cards, which require you to pay the entire balance every month. So let's go back to credit cards. The keyword is borrowing here. A lot of kids, especially teenagers, and maybe kids younger, they assume that credit cards is money that you have, that you're spending money that you have. Like when your parents swipe your credit cards, they think it's money that the parents have in their accounts. But no, that's actually a debit card. So credit cards is really like borrowing money. It's not your money. You're just borrowing it and you have to pay it back. So I remember a lot of times talking to my daughter's friends, you know, they would just assume, oh, well, just use a card or credit card. You have money on it. And they think it's money out of your bank account. So they get the two confused. So you want to understand that credit cards is actually it's like actually borrowing money. So it's not your money, you have to pay it back. And charge cards are the ones you have to pay the entire balance. That's like American Express. So if anyone ever heard of American Express, if their parents have an American Express, you have to pay the entire balance at the end of the month, which you don't have to worry about finance charges and everything. But it's really, really hard to get approved for an American Express card. Your credit score has to be excellent, like really high. And now we'll talk about ATM debit cards. So automated teller machine, ATM, and debit cards are tied to your checking account at a bank. Be sure you have money in your checking account before you use an ATM or debit card. So this is the type of card that you actually have to have the money in order to use it. If you don't, it will decline at the register and you will be embarrassed. But anyway, it's money that you have though, so you're not borrowing the money. So there are also some instances where you may have $1 in your bank account, or maybe $5. And say for instance, gas stations, some gas stations only authorize your card for $1. So some people will actually, they have $5 in the bank, they will get gas because they know the gas station only takes $1 out and they're safe. And it'll let you get gas for $30 or whatever over your balance. But you do not want to do that because you will incur fees, overdraft fees and bank fees. So you don't ever want to do that. If you don't have the money, don't use it. Just being responsible with it. And now we'll talk about secured and unsecured credit cards. Most credit cards are unsecured, requiring no collateral. And collateral is an asset that you promise to give the bank if you do not repay a loan. So collateral could be a house, a car title. It could be jewelry. It could be several things that the bank wants you to give them possession of that if you do not repay the loan. So it's really risky to put collateral up for credit cards or loans or anything. So you have to be sure that you will pay it back. If not, they can take your asset. So you have to be really, really careful with that. Consider a secured credit card if you have no credit history or have had credit problems. Secured credit cards are probably the best for young people, I would say. It's actually secured by a deposit in the bank. So you're not actually spending money that you don't have. It's secured with those funds. So it's probably the best card to start out with, even adults. A lot of adults start out with secured credit cards, and that's to build their credit history because maybe they don't have credit or their credit scores are low. So the best thing for them to get is secured credit. And you can actually build your credit score and improve it by using secured cards first. Secured cards usually have lower limits than unsecured cards because they want you to put a deposit down. And what they will do if you don't pay the bill, they'll just take that money that you have in reserve if you don't pay the bill, and then they'll close the card out. But it will hurt your credit score. So you may not be able to get another credit card. So another topic is student credit cards. These are sent in the mail, especially when you become a college student. Like Kobe is a college student. He's a senior in college in California. So he's a college student, he's a senior. So when you become, actually after you graduate from high school, you will get tons of credit card applications, right? Because they know you're going to college. And they love college students because college students usually spend a lot of money and charge a lot of money. And then usually the parents end up paying it back or they end up ruining their credit history before they're old enough to get anything, right? So you don't want to do that also. The student credit cards may have a lower credit limit and intended to help young people establish credit. And remember to read the terms and conditions. So this is your parents' decision. If your parents allow you to get one, or if you end up getting one, if you're in college, right? You can probably do it on your own after you're 18. Just be careful and read all the terms and conditions. There's a lot of fees associated with credit cards. Student credit cards are a little bit more lenient with fees, but you know, there's all types. Like my daughter's in college, she's getting Discover and a lot of different ones that aren't student cards. So anyway, they go right in the trash. But but anyway, a student card could be good if you're responsible to build your credit, to start building your credit history. So when you graduate from college or trade school or whatever you decide to do after high school, you will have a credit score instead of not a credit score where you can't do anything. So, because once again, remember apartments check for credit now. So it'd be hard to find a place to live. And reward cards. These are my favorite cards. You earn points towards goods or services. You receive cash rebates. Many charge an annual fee. And make sure the rewards you expect to earn justify the annual fee. That means like if the annual fee is $129, right? That would be for an adult, not for a kid, right? These are cards your parents will have. So if it's $129, you have to make sure that the rewards will pay for the $129 basically. So I have a reward card, I believe, from Navy Federal Credit Union. So when I applied, I received 50,000 bonus points. So I can use those 50,000 points like towards a trip or an air or flight, hotels. It has a picture of a laptop there, a MacBook Pro, since that would be my next purchase. So, but you can use them for different things. They'll have like a catalog where you can apply your points to different things, but this is probably the most rewarding card because you actually get cash back or some type of good or service or some type of incentive for having the card and spending money on the card. So every time you spend money on the card, you receive points. So these are actually the best credit cards. So if your parents have cards, this is probably the best one. And also, I wanted to talk about your parents adding you as authorized users. This is a parent decision too. So if parents want to help their kids build credit, they can also add them as an authorized user on their account, which you'll get your own credit card with your own name on it, but your parents are responsible for the bill. So if you're responsible enough, your parents may add you and, watch your spending, or they can even put locks on it to, you can only spend a certain amount. Like my daughter has access to my Apple card. And there's a limit to how much she can spend. So but she calls me before she uses the card, she calls and asks first. So that's why I gave it to her, because I knew she was responsible like that. Otherwise, I wouldn't have done it. But anyway, but parents have full control over the card. But it just teaches, kids and you how to be responsible and how not to go overboard and spend too much money, when you don't really need it. So it's really for necessity, especially when you're in college. There may be things you need, and if you're not close to home or if you're not close, you might can't get it that way. So you can use your parents' card if they give you access to it. So that's just one option. And statistics. In 2008, approximately 84% of undergraduates, which are college students, had at least one credit card. Only 17% of undergraduates paid off all their credit card balances each month, and college seniors were graduating with an average balance of more than $4,100. So what we want to do is eliminate debt as much as possible. So if you do have a credit card, if you work on campus, or if you have a job in high school or whatever, try to pay, or have your parents make sure their parents are paying the bills too, right? And just be responsible, because that credit score is going to be very important to you when you become an adult. And you want to have established credit history because, like I say, jobs check history. Like if you work for a bank, they're going to check your credit history. You get an apartment. There's a lot of reasons why they check your credit these days. So credit is very, very important now. And does anybody here have any credit cards or have access to credit cards? Either raise your hand if you know how to raise your hand, or just say yes in the chat. I would just like to know. And we'll move on. And I'll look at the chat later. Pre-approved offers. This is what college students get. What I was talking about in the mail, like every day there's tons coming from my daughter for credit card pre-approvals, right? So pre-approved does not mean you are approved. You still have to qualify for the card. Read the agreements carefully, shop around for the best rates, and opt out. You can opt out from receiving all that mail if you don't want to. And it'll be in your participant guide, so you can look at that at a later time. But the number in the website is on the screen. And these are important terms that you should understand with credit cards. The first one is APR, which is annual percentage rate. This is the cost of borrowing money on a yearly basis. It includes interest and fees. The rate may be fixed or variable, meaning the rate may not change, or variable, it changes all the time, depending on the market, and different APR for types of use: purchases, balance transfers, cash advances, and penalties. So you will have an APR for purchases, meaning something that you buy at the store. You will have an APR for balance transfers, when you transfer one balance credit card to another. Cash advances, if you ever go to the ATM and get cash with a credit card, there's an APR for that too. And penalties like late payments, over limit fees, all of that. So there's different APRs for different ways that you use the credit card. Another topic is fees. Annual fees, which I discussed earlier, for like the reward cards, like $129 a year. There's late fees. If you pay it one day late, you're charged a late fee. It could be anywhere between $35 to $50. Over limit fee, if you go over your credit limit. So if you spend more money than they allow you to spend on your credit card, they also charge you a fee between $35 and $50. Balance transfer fees, you probably don't have to worry about that until you get older. Cash advance fees, also, if you get cash at an ATM when you're older, There's fees for that. So it's really not good to do that. Get cash on credit cards. Don't even do it at all. Matter of fact, only get cash from debit cards, money that you have in your bank. Credit limit increase fees. This is very, very wrong. Never pay for a credit limit increase. A credit limit increase is when you want to be able to spend more money on your credit card. So they give you a higher limit. So say when you first open the card, they give you $500. So if you pay that credit card for 3 to 4 months, maybe 6 months, they may send you a letter or they may call you and say, do you want a credit limit increase to $800? And of course, everybody wants that, right? But a lot of companies charge for that. And never, never, never pay for credit limit increases. That's not a good practice. A good bank and a popular bank like Capital One or Wells Fargo, Bank of America, credit unions, they do not charge for credit limit increases. So try to get the increases free. Don't pay for them. And foreign transaction fees, that's when you're out of the country, if you're traveling and you spend money. A lot of credit cards have fees for this, and then some don't. So it's good to pay attention to all of those things before getting a credit card. The grace period. Avoid and minimize finance charges by paying your balance in full or making the minimum payment on or before the due date. I say pay it in full. But if you can't, like if you have to buy, for instance, if you're in college and you have roommates and everyone wants a TV to watch, like if you share a living room or anything, just say you go to Walmart and buy a TV for $500, right? A 70-inch. That has to be like a 70-inch. That's pretty big. Hopefully you won't. But anyway, this is just an example. If you go buy a TV for $500, you charge it on your credit card. I'm pretty sure you won't be able to pay the $500 being a college student, right? Or if you have a job or whatever. So it's okay then to pay, but never pay the minimum payment. I always say pay over. So probably with a $500 balance, your minimum payment may be like $12 to $15. Pay $100 or pay $50, right? Don't pay 12 or 13 because it will take forever to pay that $500 off because interest is adding every month. So it's better to charge smaller amounts where you can pay the balance off quickly or small amounts where you can pay the whole balance at the end of the month. That's the best way to do it. Many credit card companies never provide a grace period for cash advances or balance transfers. Applying for credit. There's 2 types of credit. There's individual credit and joint credit. So based on your own, individual credit is based on your own assets, income, ability to pay, and credit history. Joint credit is based on the assets, income, ability to pay, and credit history of both applicants. So for instance, it would be individual credit for you if you're getting it by yourself. Joint credit is usually for people who are married, adults who are married, or maybe one of your parents wants to put you as a joint person to help build your credit also. But I would say use the authorized user route and not the joint credit route. That way the parent is responsible for paying the bill. Now, when you become an adult, this is very, very important. Do not get a joint account with anyone, maybe unless you're married, right? But not with the sibling, not with the friend. I know they'll say, oh, I'll pay you back. Can you get a card for me and put my name on it? I'll help pay the bill. Just be very, very careful with that because you'll ruin your credit history also if they don't pay when they say they're going to pay. So it's better to be responsible for yourself and yourself only, or for your parents to be responsible for you. A lot of people, lose friendships or different things over trusting other people to pay, for things. And then it actually hurts you too. So just be very, very mindful and careful of doing that. Application requirements must be 21 unless you're a student, of course. They send you when you're a student in college. So like 18. Can show independent means of repaying the debt and have a cosigner. Providing false information on a credit application is a crime. This is very important. Do not apply for a credit card if you're under 18 or under 21 and you don't have a job or income. So do not lie on credit applications for any reason. I know some people who did this. It kind of sounds like common sense, but I know some kids who did this and, it wasn't good. But just never give false information on trying to get a credit card. Ask your parents. That's the best way to do it. And credit report. I'm going to go through this pretty fast because this is kind of advanced, but just to give you an idea, it'll be in your participant guide. You can see a sample of what the credit report looks like. But a credit report tells creditors who you are, how much debt you owe, whether you have made payments on time, whether there's negative information about you in public records, and how many inquiries are listed on your credit report. So the credit report will have your name, your personal information, your name, your address, maybe your phone number, and maybe where you work. Or if you're a student, it may have the college name on it. It just depends. How much debt you owe. It will have, like if you have a car loan or if you have credit cards, all that will be listed on your credit report, and it will tell whether you paid late or not, and whether there's negative information, like any type, late payments, really usually the only thing. Student loans, you know, a lot of adults had student loans growing up, and it's on their credit report now because they're still paying for them, and they've deferred them and all of that. So anyway, that's another story. And inquiries is when you actually apply for credit. So anytime you apply for a credit card or an apartment that you want to lease, checks your credit, or a job checks your credit, it will be an inquiry on your credit report. And you don't want too many inquiries. You want to apply for credit is not too often. You don't want too many. The 3 credit reporting agencies, Equifax, Experian, and TransUnion. These are the 3 companies that track your credit. There's more, but these are the main 3 that supply you credit reports. And I would encourage your parents, so when you get off the call, have your parents to get a free credit report on you. This is the information. It will be in your participant guide that I'll send out later for the ones who don't have it. But this is the website, and this is the phone number where you can submit a mail request, but you can just do it online or call, either way. But it's very important that your parents get a copy of your credit report. And why is because a lot of adults are stealing kids' info. So they're, you know, finding out kids' info, and they're opening credit cards, leasing apartments, like a lot of different things with your social security number. So just make sure and check to make sure that your credit report is clean, that nobody else is using it outside of your family, because sometimes that happens. So it's just a safeguard. You get 1 free per year, not per month. You get 1 free per year, and just check it just to make sure, because like I said, there's so many criminals out now, cyber criminals, people stealing information, identity theft. It's like the year for hackers now. So please, please, please get a copy of that. Credit scores, talk about this a little bit. It's a number that people use when they check your credit. There's 2 types, there's FICO and Vantage. A lot of adults don't even know this. They don't know there's 2 types of credit scores. FICO is what people use for cars, houses, credit cards, everything. Vantage score is just for you to just see it's not accurate at all. It updates every 7 days. FICO updates every 30 days. So that's the most accurate credit score. So if you have like Credit Karma, Credit Sesame, or your parents have it, they're looking at that credit score, but it's actually, and then they go apply for something, they get denied, and they don't understand. Well, actually, it's because the Vantage score is not a real score. It just gives you an estimate of what your credit score may be. The FICO score is like the record, like the most important. If you get denied, they have to tell you why you're denied. They have to give you a reason. They'll send you a letter in the mail to tell you why, like so many days after you apply. And it could be from bad credit history, or you don't meet the income requirements. And if you ever lose or your credit card is stolen, please tell the credit card company immediately, because of identity theft, right? Because people can use it and charge your card up and everything. So you don't want that, because you'll be responsible for it. So please let them know immediately if something happens. And never give your confidential personal information over the telephone unless you make the call. I get spam calls all day. I had to turn the block on my phone because they call me all day pretending to be AT&T, that somebody bought an iPhone 13 on my account and I need to cancel it, but I need to give them my information so that they can cancel the order for me. They're real tricky, so you have to really watch them. So anyway, just keep in mind, be mindful of that. And identity theft, I already kind of said it, when thieves steal your personal information and pretend to be you. So identity theft is a serious problem. Get a copy of your credit report. Let your parents know it's free, 1 per year, just to make sure. And the credit card statement, there's an example in the pages, in the participant guide. Won't go over that. It's a little bit more than you need to see right now. And there's activities in the participant guide. So after the class, you can do the activities or whatever. And paying your credit card bill, we went over that. Try not to pay the minimum payment, pay a little bit more. So you're not paying so many interest, and actually pay the whole thing off if you can. And that's it. This is like a little cartoon or whatever. It's in your participant guide, so you can read over that too. And congratulations, you've learned the purpose of credit cards, where you can go to apply for a card, how to decide which credit card is best for you, or if a credit card is a good idea for you at this point, which no, it's not, unless you're on your parents' card. What credit card companies look for before they issue a card, and how to use credit cards responsibly, and how to safeguard against identity theft. So now I would turn it over to Kobe, and he will go over cars and college finances.
Thanks, Caryn. Yep, as Caryn mentioned, I'm going to be going over college and car finances, and want to say thank you to everyone for coming out today and joining the workshop. It's much appreciated. So let's get right into it. So the objectives of this module, we're going to learn the different types of installment loans, secured versus unsecured. We're going to look at the factors loan lenders use to determine if a client is qualified to receive a loan. We're also going to go over car loans and car leases. And then at the end of the module, we're going to learn about how to pay for higher education and different alternatives as well. So first, we're going to go over installment loans. What is an installment loan? It is a loan, which is money you borrow and must repay back. You know, it's not magic money. It's not given for free. You got to pay it back. And usually the payments are in monthly installments over a set period of time. Some examples of installment loans are mortgages, auto loans, and student loans. Usually the time length can vary. It can range from, the monthly payments can range from 1 year to 30 years. For a mortgage example, it could be 30 years, but an auto loan could be a smaller amount of time. As I mentioned, there's two types of installment loans, secured and unsecured loans. Secured installment loans have collateral that you offer if you can't pay the loan back. So for example, if you say you take out a car loan, you buy the car with the loan and some money maybe you have, and you start getting billed monthly to pay back the loan. If you're unable to keep up with those monthly payments, you have to return the car in order to pay back that loan. As Caryn mentioned earlier, the collateral can be in many forms, but specifically with car loans, if you're using that loan for a car, the car is collateral, so you have to return it if you can't pay it back. On the other hand, for unsecured loans, the loan you borrow is not secured by collateral. So if you're struggling with the payments, there's no way for you to offer something in order to pay back the loan. Now I want to ask y'all a question. Is a student loan a secured or unsecured installment loan? And feel free to unmute yourself or type your answer in the chat. It's all right if y'all don't want to answer, but I guess I'll...
Yeah, there's no responses in the chat yet.
All good.
Oh,
Let's see more.
Caryn said unsecured.
Which is correct. It is an unsecured loan. And the reason why is because you can't offer collateral. You know, with the car loan, you offer the car, but with student loans, there's no asset that you can give to pay back the loan if you're struggling with it. Now that we know the two different types of installment loans, we're going to look at what are the factors lenders use to determine if a client is qualified for a loan. And those factors are the 4 C's: capacity, capital, character, and collateral. Capacity is basically how much money you're bringing in. your income, your investments and assets. In short, the amount of money you're bringing in every month. Capital, on the other hand, is how much money you currently have in your bank account, and as well as other investments and assets that you currently own. Capacity is money flow coming in, but capital is the money that you already have at the time of the loan. Character is not only how you are as a person, but your credit history. So they'll ask questions like, about your payments on time in the past. Like, have you made those payments on time? Do you currently have credit? So, as Caryn showed with credit affects everything going forward. So it's key to have that on point. And, in order to get loans, they're going to ask questions about your credit. Lastly, collateral. We kind of hit on it. It's similar to capital, other assets, your house, car, different items you might have that are worth money that you could sell and, use if you need to pay back the loan and the payments are tough to manage. You could offer those in exchange. To get more information on car loans, you can search up the Federal Trade Commission on the internet. And some requirements: you must be at least 18 years old, and you need to show that you have sufficient income to pay the loan from the start. So you have to at least have a job and show that you have money coming in at minimum. Along with car loans, there are car leases, and there's some differences in, ownership, wear and tear, monthly payments, mileage limitations, and auto insurance between the two. So for example, with a lease, you never own the car. With a car loan, if you make all the monthly payments, at the end, you do own the car. But as long as you're leasing a car, you'll never own it. With a lease, if there's extra wear and tear on the car that's documented in the contract, the dealership will charge extra money at the end. This is not the case when you have a car loan. So if you're leasing the car and you get an extra scratch on it, the dealership can charge you extra for that scratch if it's outlined in the contract. Monthly payments are slightly lower for a lease, but you'll always have these monthly payments if you lease the car. With a car loan, the payments are only for a set term. And sometimes the lease payments monthly aren't even as low as a car loan because it depends on what car you have. If you have a really nice car, the car lease payments are going to be really expensive. Mileage limitations. The number of miles you drive when you're leasing a car is limited. And for all those extra miles you're driving, based off the limit in the lease contract, the dealership is going to charge extra money. This is not the case with a loan, like with a car loan, and you're making your way trying to own the car. And lastly, auto insurance is generally higher if you lease in the car than if you have a car loan. In the long term, purchasing a car is more cost effective, but a lease is cheaper in the short term, but you'll never own the car. Car is collateral for the loan, as we went over. If you cannot make the payments, you have to return the car. The lender owns the car title until you pay off the loan. Monthly payments depend on the price of the car, the APR, the annualized percentage rate, as Caryn went over, which is interest, which is how the lenders make money. If you only paid the amount given, there's no profit on their end. So the APR is required for them to make some money. And also the monthly payments depend on the length of the loan. If it's a shorter period of time, the monthly payments are generally going to be higher versus if the loan period of time is longer, then the monthly payments might be slightly lower. I want to check in with y'all again. Feel free to unmute or say in the chat, but when you lease a car, do you own the car? 1, yes, I own the car, or 2, no, I am renting the car.
We have responses in the chat. They're saying no.
Very good. Yup, that's exactly right. No, the car lease is essentially a rental car. There are many different places where you can obtain a car loan. There's four main ones: banks, credit unions, finance companies, and car dealerships. Here I want to show you a little cost breakdown of an example of what car payments would look like. So for a $16,000 car, you would usually have a $2,500 down payment. And then over 5 years, you have to pay $225 a month. And then there's an additional $575 in tax and registration fees, which totals around $16,575. So now that we know about car loans and leases, should we take out that loan or lease the car? Which option should we choose? And it's actually neither, because there's a better option. The better alternative is to buy used cars with cash, because there's many advantages. One, you own the car title right out the gate. As you make that first payment, it's usually a large amount of money, but a lot cheaper in total. You own that car right out the jump. There's no monthly payments after that first payment. And as I mentioned, it's usually cheaper overall. It's essentially like a big down payment, as we showed earlier, with no monthly payments afterwards. Looking at car purchases from best to worst, ideally you'd want to try to buy used cars with cash. The next best option might be to take out a car loan you can afford. And what you can afford, meaning the monthly payment is no more than 20% of your monthly expenses. And then the third best option would be to lease a car that's not too expensive, one that you can afford, which is again, a monthly payment on the car that is no more than 20% of your monthly expenses. Not saying that it's always like this. There might be times where leasing a car is better, especially if you could get a deal or, you can get a good APR on a car loan and whatnot. And the car loan is helpful because it gives you the money right away to start paying. But always be careful with loans and leases. Leases, you'll never be able to own that car. And with loans, you have to pay that money back or else you have to return the car. It's not magic money. And you always want to watch your step and be careful when handling with loans. There's a lot of fine print. The contracts are sometimes really long. So just always read the fine print and always ask questions to the lenders about things you don't understand. Don't hold back any information that you might be curious about. You want to make sure you know everything about the car contract because, there's some stuff in the fine print that will come up later that you didn't know about. So always be careful about that and ask questions. Now that we kind of went over the basics of car finances, I want to talk about college finances. There are 3 common ways to get federal aid. There are Pell Grants, student loans, and the College Work-Study program. In order to get any of this student aid, you got to complete FAFSA, which is the free application for federal student aid. So, if y'all are seniors, the application is going and it's open till March. But I would suggest applying as early as possible. And some of you might be younger than high school seniors. So, at the time of application, you want to be the first, you want to apply basically that first week, which is usually in October it's open. And it's open from October to March. And an analogy I was told when I was going through the college application process was like federal student aid and FAFSA is like a bank and they're giving out money. And, to get the best chance of the money, you want to be in the front of the line. So that's kind of what it's like applying early. Your application seen first, you have a higher chance of getting as much money as possible. Here's some additional tips. As I mentioned, applying early as possible. You want to read all the application instructions, and the FAFSA requires you to complete tax return forms. So that would, you need to ask your parents. There's some info for them to fill out about, their expenses, and there's additional forms. So if you look up FAFSA, FSA, federalstudentaid.gov, you can create an account and start that application, when you're looking at applying to colleges. One form of student aid that's the best ideal is scholarships. It's money for college that you don't have to pay, that you don't have to pay back. So it's not like a loan, where a loan, you are given that money, but you're expected to pay it back. With scholarships, it's money that, I'm sure money you're given based off your profile, whether it's athletics, your experience, where you're at, where you're living at, etc. And because of this, there are some fishy websites out there scamming people to get their information. So you always want to be careful. Collegeboard.org is a legitimate organization. They, run the SAT tests and there other different tests and like college help and information. So, if you go to this link here, it matches you with, scholarship information. You enter your information and they match all the scholarships that you qualify for. And there's a bunch out there. There's money to be gotten for these, programs. So keep an eye out and apply to as many as possible. Usually they require additional forms or, essays. So you got to show why you're the best candidate for that. Other grant programs are like Pell Grants. So these are similar scholarships. It's money given that you don't have to pay back. And there are many, as you can see. There's service grants, higher education grants, and then other grants from different institutions. The third most common form of federal student aid is federal loan programs, and you need to be very careful with these federal loans. They're the easiest to get, but they're also, if not handled properly, can be a pain in the butt. You can't declare bankruptcy on these. Like a loan, you have to pay them back, and usually there's a really high interest rate. So, taking out a loan is not magic money. You're not given this money and expected to not pay it back. You have to pay back everything you borrow. And usually with the interest rate, you might pay a lot more than you borrowed. So, take these loans very seriously, be very careful. And, if you learn one thing, is to always be careful with student loans. So I want to walk through basically the average student loan payments and how much of that like in total. So the average monthly payment for a student loan is $400 a month. And on average, it takes 20 years to pay off the loan. So you take $400, and for $400 times 12 months equals $4,800 a year. And if it takes 20 years to pay it off, you take 4,800 times it by 20. In total, people have to pay off $96,000 on average. And that's a lot of money for taking out, loans, payments. So again, you got to be very careful. You can't declare bankruptcy. You can't offer collateral. As we talked about earlier, student loans are unsecured loans. So you can't offer something up you have in order to pay back the loan. You have to pay it back through your capacity, through your income. So, and if you show the bank or whoever your lender is, look, I can't make these payments. These are tough. There's no other option. You're kind of stuck with them. So be very careful. The old adage I was always told is if it sounds too good to be true, it probably is. So, it sounds well and good to get all this money from a lender, but at the end of the day, you got to pay that money back. So be very careful, take this very seriously, and write out a plan, write out, how much money you're taking out and how long would that take to pay off. So that always helps looking at it like this way. And then there's also alternatives for higher education. There's junior college where you can earn a 2-year degree, or you can take those credits and transfer it to a 4-year university. So in junior college, the tuition is a lot cheaper. You can stay at home and save money on housing, and you can work a part-time job to basically make up that tuition cost, and you're not out any money at the start. There's also trade school, which is usually 2 to 4 years, where you learn a valuable skill and you get paid well right out the gate. Some examples are like electrician, hairstylist, chef, carpenter. There's a bunch of different trades that schools offer to teach, and you can get work right at the gate. People always need a chef. You can always find work, and once you build up the experience as working in a trade, you also have the chance to run your own business. You can open up your own salon, you can open up your own electrician company, and there's a higher chance for you to run your own business as well. Another good alternative is the internet. YouTube, online courses. There's so much information out there, especially now in 2021. And you can learn about anything if you just search it up. So take advantage of the internet. Always, if you're interested in something, look it up and see what's available out there. Make connections, reach out to people like where they are at. Reach out to people who are where you want to be. At the end, you can always reach out to Caryn, Dia, or I. We would love to help and give you information or additional help, or if you need references, we're always there. And lastly, the military, it's another great option. You could, as you serve, you have the chance to go to college for free. Your tuition, your housing, your room and board is all paid for, so no cost at all. I want to check in again with y'all, and this is a cost comparison. If you went, for example, 4 years at a university versus if you went 2 years junior college and 2 years at a 4-year university. So if you went 4 years, the same tuition price, you could see around $18,000. But if you went 2 years at junior college, the tuition is only $3,000. And then if you compare the total cost savings, it's almost $30,000 you save by going 2-year junior college route. And again, you have the chance to work a part-time job here and reduce that cost even more. Another form of paying off college is the Federal Work Study program. So Federal Work Study gives students the chance when they're in school to reduce their tuition by working a part-time job, usually on campus. You could also pick up a job off campus as well, but Federal Work Study usually is pretty secure and stable. There's always work, and they just slot you into a job right away. So this is another good way to reduce your tuition. You always got to keep in mind the hidden costs of college. There's not just tuition, you have your books, housing, food and other fees and whatnot. So always got to keep in mind that, there's a lot of money that eventually goes in. So, always, make sure you're keeping your balance sheet and, calculating all the costs, because it adds up, and as we went over, there's a bunch of alternatives. If If you're not interested in college right away, that's okay. You know, or you could go junior college for a little bit, you know, get an associate's degree and start working. Again, there's trade schools, so always keep your options open. Be very careful with these loans. It's kind of sad when these lenders are kind of preying on the lack of knowledge people have by signing them up for loans that they know they can't afford, but just people aren't informed. So just make sure you're very careful. This is money you have to pay back. It's not money given to you for free, the loans, and to just apply for student aid, federal student aid, and scholarships. There's always hidden costs. I also forgot to mention with the cars, you know, if you're taking out a lease, you know, maybe you can afford a pretty nice car, but you got to keep in mind the other costs with the car. You know, it's not just the monthly payment, but you know, there's services. You know, with a nicer car, the car services are going to be much higher. You know, the parts of the car are much more expensive. You know, if you're driving a nice luxury car, you know, the tires are, you know, more expensive than if you have a common economy car. The brakes, you have to probably get nicer gas, you know, the premium gas, not regular gas. So just keep in mind the hidden costs and everything of cars and finances. You know, there might be a time when you need a, you know, the car breaks down and then, you know, you got to pay for that as well. So just, yeah, at the end of the day, keep in mind of those hidden costs. And congrats, you all learned about cars and college finances. We learned about secured versus unsecured loans, the 4 C's of loan decision making, which is capacity, capital, character, and collateral. We learned about car loans and auto financing, and we looked into ways to pay for college and higher education, as well as different routes. And that's about it. Are there any questions y'all have?